Hey gang, welcome to Time in the Market, the investing channel with a long-term focus. Figured I'd do a quick video about the mayhem in the market. If you're on Twitter, if you're on anywhere in the stock market, message board, discussion space, it's almost as if it's the end of the world in December. Certainly, certain high-risk stocks have gotten pummeled. SPACs are in that world. If you watched my videos, I do talk a lot about SPACs, and a lot of SPACs are down 30, 40, 50, 60% off of their highs with what's happening in the market. But in reality, the market as a whole, outside of a small percentage of high risk names, hasn't been doing that terribly just yet. It's been handling itself pretty well. If you look at the Russell 2000, in the last month or so since the peak, it's maybe down 10 to 11%. Certainly not great, especially if you bought at the peak, but always when you look at these things, when in doubt, zoom out. Year to date, the Russell 2000 is still up 9%. In the last year, it's up over 10%. So short-term pain, long-term, it's still doing pretty well. Might not be the case for every one of your stocks, but if you're an index investor, which I mostly am, it's not the worst. It's never great seeing your money evaporate in front of your eyes, but I don't need this money for 7 to 10 to 12 years. So the lower prices are better for me in the short term. The market has gotten a bit overheated. So that's why we're seeing the correction. And I'll talk about why the correction is happening, why I think the correction is happening. As always, guys, I'm not a qualified financial advisor. Please do your own due diligence. Talk to a professional before making any decisions about your investments. I'm just here to have fun and talk about what I think about the market. Full disclosure, I may own some of these stocks. And full disclosure, please do your own due diligence. So if you look at what's happening in the market, really it hasn't impacted the S&P 500 that much just yet. In the last 3 months, the S&P 500 is still up. And if you go to the latest month, it's down a little bit, 2%. But overall, some of these bigger names have held up pretty well. You see a similar thing in the Nasdaq, although that's down a bit more. It's really the small cap stocks that have been beaten down. The Nasdaq, though, if you kind of look at peak to trough in the last month or so, maybe you're down 1% or 2%, not a huge deal. But again, when in doubt, zoom out. The Nasdaq is up 25% in the last year. Big gains have been had. And we're giving some of it back, but that's just the reality of the market. What's going on in the market today is not anything amazing. However, if you do look at some of these high-profile growth names, you can kind of see, hey, if I bought this stock just about a month ago, I'm down 36%. Less than a month ago, it's down 36% since the middle of November. That's kind of a huge dip, and this isn't uncommon with some of these high-flying growth names as the stock market kind of starts to reevaluate these, given the background of what's going on today and the various things that are happening that yield uncertainty in the future. Some of these names are getting punished. And why are they getting punished? Because even after the drop today, the valuation here on a forward multiple is still 50x. On a trailing multiple, it's 72x. So still very rich valuations for some of these stocks. And the market is basically saying, I don't know what's going to happen in the next 6 to 12 to 18 months. And I'm not comfortable with a lot of this money sitting in some of these names that are priced as aggressively as they are. Again, remember, this is a 72x trailing multiple. On a sales basis, the S&P 500 is probably in the 3.5 range, so that's a big difference. This has even hit some of the more recent SPACs that I've even talked about. If you look at Planet Labs, still a good company, but it's down 40% since it kind of de-SPACed, and a lot of people who invested in this based on potentially my video or some of the videos or some of the talk on Twitter, you're down 45% in a matter of a couple of weeks, really. That's tough to swallow, but that's the reality of SPACs, and I've talked about this in my video. Jim Cramer recently said that SPACs are a bad deal, but if you look at IPOs, you're seeing the same type of thing. If you have the Robinhood app, they have something called IPO Access, where they give you access to IPOs, and Nubank down basically below IPO price, Iris Energy down 40%, Sono Motors down 34%, Vaxinity down 48%. Expensify is up, Backblaze is up, NerdWallet down 15%, Bird down 5%, etc., etc. Robinhood, a big IPO a couple of months ago, down 52% since IPO price. And the interesting thing is, remember, most of us do not get that IPO price. If you bought Allbirds, you're down 50% since the IPO at a time of launch. If you were like, I love Allbirds, I love their shoes, I'm going to buy them. The stock opened at $29, IPO price was $15. Well, it's back below that. And this is a company I like. I wear their shoes. My wife wears their shoes. I know a lot of people who buy their shoes. I think long term this will be fine, but losing 50% over a month is never fun. Similar thing with Planet Labs. If you kind of look at this company, what's happening right now in the market is a reevaluation of a lot of these names that are out there with uncertain futures, right? The reality of Planet Labs is the upside here is essentially driven off of potential growth that may or may not happen. If you look at their historical data, they've grown at 18% or so. The thesis for those who invested in it is that based on the investor presentation, based on the $500 million they're going to get in cash, they're going to be able to spread into different verticals, not just be beholden to the government or Google or whoever industry or whatever small industries they work with right now. They want to expand into other spots and use their data to do that. And if they grow at 40%, today's valuation is quite attractive at that level. And this shows 10.5x. This is incorrect because that doesn't account for the cash they just got. So it's more of a 6.5x area. However, the other side of this is that the market has also reevaluated names like PayPal. So if you look at something like that at 6.5x, and then you look at something like PayPal at 7.5x, there's also this push and pull that some of these high risk growth names have come down, but so have companies like PayPal, which is down quite a bit in the last month. And now the valuation discussion starts to be, well, is Planet Labs a better deal or is PayPal a better deal? Well, if there's uncertainty in the horizon, I'm certainly more certain that PayPal 5 years from now is going to be a strong business than I am about Planet Labs. However, Planet Labs probably has more upside if they can execute on their plan because PayPal is growing at 17, 18%, maybe slower in the future. If Planet Labs can really grow at 40%, then there's certainly a ton of upside there. So why is all this happening? Well, there's a couple of reasons. First, the stock market's expensive, right? Whether or not you look at the small cap space or even the stock market as a whole, you're paying 38x for the S&P 500 right now, which is about as high as it's ever been. The only time it's been higher is in the 2000s. And after that, the bubble popped and it dropped like a stone for 3 years in a row. There are certainly some differences there. In 2000, the yields on bonds were in the 6 to 7% range. The yields on bonds today are in the 1.4% range. However, what's driving some of these reductions in price is now we have a bit of an inflation problem. Some say it's transitory, some say it's not. And the Fed has signaled that, hey, we're going to stop purchasing as many bonds. We're going to stop and slow quantitative easing in the near term. In the longer term, going into 22 and 23, we're probably going to raise rates 2 to 3 times per year. So right now your 10-year treasury rate, which is somewhat impacted by those rates, are at 1.4%. Yes, the S&P 500 looks expensive at 38, but if you do the inverse of this to get an earnings yield, you're paying about 2.7% for the S&P 500. Compare that to the 10-year rate at 1.4%. Still looks pretty good. Now, with inflation up, you can get 7% from I-bonds, so maybe some people are moving their money there. But at the end of the day, the stocks and the bonds, they compete against each other for investors' money. And if there's the potential for some of these rates to go up, if the 10-year 2 years from now is suddenly 3% or something like that, and you're paying 2.5% earnings yield for stocks, then maybe some of these PE ratios have to come down to kind of mirror what's happening in the bond market. That's problem number one. Problem number two, and that's partially what's driving these changes in the Fed's actions. Inflation's rearing its ugly head, and that's going to impact a variety of things. Companies are going to have to pay more for their supplies, which is going to impact their earnings. And if earnings slow, then that's going to impact the PE ratios. If the PE ratios assume a certain earnings growth rate and that growth rate slows, that's a problem. Secondly, inflation impacts what you and I can buy at the grocery store or for rent. If we can no longer afford certain things, then certain industries may be harmed. Allbirds, for example, it's kind of a luxury good, right? You're not paying $100 for shoes all of the time. If suddenly your grocery bill is up 10% and your rent is up 10%, maybe 20% of their customer base disappears and they're going to tank, right? If their growth rate slows down and the market is expecting a certain growth rate from companies like that, then that's a problem. If companies are spending more money on their supplies and not raising prices as much as they would because they don't want to lose market share, then that's going to impact the services they can buy. So maybe Planet Labs will have a harder time growing their customer base and things like that. On top of that, if that happens and inflation isn't stopped, you can have something called stagflation, which is not a good thing. So there's a lot of issues happening in the market right now. On top of that, you've got another variant of our old pandemic, right? That doesn't seem like it's a big deal right now, but there's already talks of closure in certain European countries. That's going to impact the supply chain. That's going to impact the ability for some of those international companies to make money. Maybe the people, maybe further layoffs, something that we saw in 2020. I doubt any of that is repeated, but that's certainly going to put pressure on earnings, certainly going to put pressure on the way people view the stock market. And money is going to flow out of riskier names simply because there's a lot of uncertainty happening right now. And that may be a short-term thing. If the variant turns out to be not a big deal and we go back to normal and this is the end of the pandemic because everybody sort of gets it and it's mild symptoms and there's no more variants in the future, then maybe these growth names that have really been punished, that have gone down 40 to 50%, are going to shoot up right away into the stratosphere. But if this is a longer term thing, then maybe those growth names are just the first domino to fall in repricing of the entire market. Right now, like I said, the S&P 500 hasn't been that impacted. The Nasdaq hasn't been that impacted, but it may be in the future. So there's a lot of uncertainty here. But again, like I said, I am a long-term investor. Am I doing anything? Not really. I still have some exposure to SPACs. I've certainly had a couple of SPACs that have dropped 40 to 50% within a matter of weeks. I post about some of these things on Twitter. I do sell SPACs from time to time. A lot of my strategy is, for example, Matterport is a good example. That thing ran up to $30 plus, and I was able to basically sell a third of my position, and now I'm covering my cost basis and I'm letting that flow. But companies like that are priced so aggressively that it makes me feel like, hey, if some of those stocks drop 50% from where they are today, the 50x multiple stocks that aren't growing at 50% plus, like Matterport as a good example of that. If they fall another 50%, am I going to be surprised? Not really. If the S&P 500 falls 10, 20, 30%, am I going to be surprised? Not really. It really depends on what happens. Is inflation going to impact us? Are we going to move into a recession because of the things that are happening with the next, with the bill that Mr. Munchin is saying he's not supporting anymore? Again, that may be a good idea or a bad idea. Spending $2.2 trillion in an inflationary environment might not be a great idea. However, supporting the middle class who are struggling during this pandemic and now are suddenly going to be left without a life raft, that might be a bad idea as well. So there's good and bad with the bill itself and supporting it or not. So all it comes down to in the end is there's a ton of uncertainty here. And potentially some trouble ahead. Although, you never really know. That's why it's so difficult to time the market. That's why you'll see people on Twitter freaking out if they're a short-term investor. It's like, oh my Lord, what happened? That's not my play. I invest with a long-term mindset in mind. Do I think Planet Labs is doomed? No. They just got $500,000. They have a relatively okay enterprise value. Might be relatively expensive if they can't get the growth they promised. If there is a recession or something like that, still could fall further. But 5 to 10 years from now, Do I think it could be a good return at today's prices? Yeah. Have I bought more? I have. I've bought more of Genius Sports when it fell to $6. Now it's back up to $7. I think there's a lot of value in some of these SPAC companies right now. And I'm looking at them and I'm kind of taking bets here and there because I still do have a decent amount of cash. I've talked about this before, that I've not been buying a ton of growth names in some of my portfolio updates. Well, I've started to buy some growth names again because they are looking a bit more enticing at this level. I think some of these companies have fallen so severely that even if there's a recession ahead, I'm not too concerned about buying them with a 5 to 10 year mindset in mind, right? That's how I buy things. At the end of the day, if the stock market falls 30% tomorrow, it's certainly going to suck on paper for me, but I'm still employed. I'm still investing right now. I'm still in my investing phase. I'm still in my accumulation phase. So from that perspective, it's better for me to buy at a 25 PE or a 10 or 15 PE than it is to buy at a 38 PE. And again, I'm not saying that the market's going to fall. I'm not saying that it's going to rise because nobody can know that. That's why I think long-term investing is the right way to do it. And I am going to continue buying every time I get paid. A lot of my money is going to go into index funds. Some of my money is still in cash. My investment plan calls for 10% cash maximum, and I'm not too far away from that because I felt like, hey, maybe we're kind of aggressively priced here given what we know about the market. And I don't think that's changed. I think we're still aggressively priced in a lot of ways. I think some of these growth names that have fallen a lot have become a lot more attractive. I talked about PayPal in another video that I just did. But I'm still a bit wary because there's so many unknowns. There's the rising yields, there's inflation, there's these variants, there's potential lockdowns, there's multiple things that are impacting the market. And really, it hasn't reacted that aggressively on the whole, right? There's certainly been stocks that have been impacted negatively in a big way, but the S&P 500 is still relatively aggressively priced. The Nasdaq is still relatively aggressively priced. There's potential for a correction, but there's potential for none of that to happen, right? If the inflation indicators start moving the other way, if it is really transitory, maybe those rate yield increases don't happen as aggressively as they would. Maybe this variant isn't as bad as people think it is. Maybe these lockdowns are overacting. Who knows, right? That's the mystery of the market. At the end of the day, if you have a 10-year outlook or longer, which I think a lot of you do based on my channel metrics, most of my viewers are in that 24 to 39 range. You're probably investing for 20 to 30 years from now. Invest in index funds. Put a couple of percent aside for plays that you want to make, but investing 100% of your money into growth names that are probably way overpriced right now, or certain stocks that might be overpriced right now, it's probably not the right play for me. For you, whatever. You have your own journey. Do what you want. Again, this is not an investing advice channel. It's kind of me sharing my journey with you guys. And this is what I'm looking at with the market. 90% of my money is still invested mostly in index funds, mostly in the S&P 500, in the Russell 2000, in the Nasdaq, and things like that. Some dividend funds, some dividend stocks, as you know from my M1 Finance updates. So I'm not too worried. If the stock market drops, I'll just buy more. I'll get more shares with each stock market buy. So it is what it is. At the end of the day, these day-to-day things don't matter to me. So if you're wondering why I'm not making all these videos, well, a lot of things don't just seem that appealing to me right now. A lot of the SPACs that came out are kind of I own PRPB, for example, taking Getty Images public. Am I going to hold that one? I don't know. Historically, in the last 6 months, it hasn't been a good idea to hold anything past the D-SPAC. Grab is a good example. Thing fell from like $10 to $7. I'd certainly like Getty Images at $7. I think it's a good company. It's a company that I've actually used and contributed to. And I think long term, it's going to be a good return. But at the price they've gotten, it's reasonable. It's comparable to Shutterstock, and it's actually a better value than Shutterstock. But would I be buying Shutterstock right now? No, I don't think so. I think there's some downside there. but it's certainly a stock I'll revisit and kind of look at again before it de-SPACs. There's some upside with NFTs, all of that nonsense. But again, it is what it is. If you go back to, 2018, we had a similar December mini crash that quickly recovered and turned out to be a great buying opportunity. Maybe that's the case here. I'm certainly buying certain things. Like I said, Genius Sports is an example. But I'm not all that concerned about what's happening right now. And I'll continue buying on the way down or on the way up. I'd actually prefer somewhat of a correction here because, again, my timeline is 10 years out. So buying at lower prices means better long-term returns. The assumption at a 38x multiple is that your future returns are probably going to be 2 to 3% plus GDP growth, which is maybe 5% tops. That's not great. I'd certainly rather buy lower than today's prices to get better long-term returns. So overall, lots of unknowns. Let me know what you guys think about the stock market today. Are you worried? Are you panicking? I think there's a lot of panicking going on right now. But if you're panicking right now, you're going to be in a world of hurt when there's an actual recession. Remember, 2008 took a couple of years to recover. I was part of that. I was already investing at that point. My stock holdings, much smaller than today, dropped 40 to 50% in a couple of months. But I was buying a lot when that happened on the way down. And the recovery, once it happened, was amazing. Took a while, but it was amazing. 2000 was harder than 2008 because the recovery wasn't as swift. If you bought in 1999, it took a while for that money to recover. You kind of were struggling. The return there wasn't great after 2000. It took a while for things to start moving, and then 2008 happened, and it kind of brought you back to nothing. And then since then, we've been on a rocket ship to the moon, and that's eventually going to have to stop. There were mild corrections here and there, but we're due for a recession, and maybe this is what causes it. I don't really do anything on the downside. I don't buy puts because by the time you think that puts are warranted, the option prices are way too high. So whatever, if I needed the money, I'd certainly do protection on the downside, but I really don't. I have a bunch of cash on the side that will work for now, and I can buy on the way down. I can buy on the way up. So interesting market we're in. We'll see what happens past 2021. If I had to guess, I'm probably a bit more bearish than bullish, but we'll see. We'll see. I think anytime you have inflation, anytime you have rising rates, anytime you have the uncertainty of the pandemic, that's a bad combination. But projecting the market is a fool's errand, so I won't do it. If you looked at March 2020, you would have thought that would have been a disaster and the recovery would have taken forever, but it took a month and we were back running, so maybe we'll be back and running again. Maybe Mr. Munchin will see what's happening. He'll come back and say, yeah, let's do the bill. More money will be injected into the market. Inflation will calm down and things will be amazing. Or things will explode and, short-term investors will really get boned. But that's why having a long-term mindset is the way to go in my mind. So, guys, as always, thanks for watching. Let me know what you guys think about the market today. Remember, not a qualified financial advisor. Please do your own due diligence. Talk to a qualified financial advisor before investing. I am not recommending anything. I am long most of the stocks I talked about today. The stock market is a unpredictable beast, and things can go up when you think they'll go down. Things can go down when you think they'll go up. And it's better to just not worry about it too much. Invest with a long-term mindset. Buy high-quality companies that you have absolute faith in. And if you don't have absolute faith in them, make them a very small portion of your portfolio, just like I do with SPACs. They're probably 3 to 4% of my overall portfolio, but certainly offer plenty of upside with plenty of downside. I don't think SPACs are as terrible as many say they are. There's certainly downsides with them, but there's also downsides with IPOs, as has been evidenced by some of these IPOs that have gone public and are already trading below IPO price a couple of weeks after they have gone public, and IPOs like Robinhood being down 50%, etc. So a lot of negatives in the market, a lot of positives. So who knows? Who knows, guys? As always, thanks for watching and have a good rest of your day.